Gold dripped. What the snap really signaled. Gold just flashed the system's nerve endings. Record, then recoil, then reveal. On October 21st, gold printed a fresh intraday, high near 4,381. By October 22nd, it shed about 5.3%, even as the dollar barely budged and 10-year treasuries didn't panic. That's not a garden variety swing. That's an institutional message. When the ultimate reserve asset hits a high, then slips in 24 hours, while policy rates sit at a lower band and fiscal arithmetic tightens, markets aren't only pricing volatility, they're probing confidence. The last time gold spiked while rates were steady into heavy issuance, liquidity pinched in other places first, not in the headline price. Here's the mechanism. Policy cut into decelerating growth invites a test. On September 17th, the Federal Reserve set its target range around 4 to 4.25. That's looser than earlier this year. Meanwhile, the Treasury's interest bill keeps stepping higher as low-coupon pandemic debt gets rolled at current coupons. Translate coupons, plain English. A coupon is just the annual interest rate stamped on a bond. Roll 2% notes into 4+, and the system's interest math doubles on that chunk. The arithmetic doesn't care about slogans. Real yields versus gold. Real yield, plain English, the inflation-adjusted yield. When real yields climb, gold usually softens. When real yields slip, gold tends to firm. The snap after the record came, while real yields paused near cycle ranges rather than collapsing. That flags a credibility read, not a pure inflation scare. The pattern didn't start last week. It traces back to repeated contradictions. Central banks have been steady buyers of metal for multiple years, diversifying reserves. Yet price still whipsawed hard after a record. That's institutional two-step. Strategic buying on one horizon and tactical de-risking on another. Record, then recoil, then reveal. Let's anchor the calendar. On October 16th, fiscal year figures showed a deficit well north of $1 trillion, with outlays towering over receipts and interest costs becoming a headline line item. On October 20th, total public debt printed near $38 trillion. On October 21st, gold topped intraday. On October 22nd, the quick drawdown arrived. And on September 17th, the policy rate cut framed all of this. 5 dates, 1 cluster. Does that look like random noise? Or a system finding its constraints? Now the deeper current. Issuance is the silent protagonist. When the Treasury increases coupon supply into a market that's already digesting quantitative tightening, someone has to take the other side. Primary dealers step in, balance sheets stretch, and term premium nudges higher. Term premium, plain English. The extra yield investors demand to hold longer dated bonds instead of rolling short bills. When that premium rises, it competes with gold on the same shelf marked safety in a storm. Scale matters. Annual net interest outlays now rival core national programs. At points this year, the interest line has crept toward parity with defense-level spending. That's a budget reality with market consequences. A system that pays more to service yesterday limits options for today. Markets price that constraint before politicians acknowledge it. Gold hears it early. Historical parallels keep returning. In August 1971, convertibility ended and gold left its peg. In September 15, 2008, credit seized and flows scrambled for safety in the least fragile plumbing. In March 9, 2020, cross-asset margin calls forced selling of safe things to cover losses in risky things. Those were different regimes, but the rhyme is clear. When collateral needs rise, even safe assets can drip before they rip. The trade broke before the thesis. So what triggered the latest snap lower after a record? 3 forces collided. First, profit-taking by institutional desks that rode the late summer momentum. Second, collateral needs around quarter-end and refunding windows where balance sheets prefer liquidity over mark-to-market risk. Third, policy signalling. A rate cut into inflation that still reads above the 2% target invited a credibility audit. Markets asked gently at first, is growth fear now stronger than price stability fear? The auction triangle. Treasury auctions, coupons and tails. Auction tail, plain English. How much the auction clears above the when issued level. A big tail implies weak demand. A sequence of soft auctions pushes yields up, strengthens the dollar on carry math, and often leans against gold. A firm auction sequence does the opposite. The next cluster of coupons matters more than a week of headlines. Now the mechanism in numbers. Lightly, so the signal stays audible. Debt was issued near 2% in 2021. Roll that at 4 plus through 2026. Every trillion rolled doubles the interest bill on that slice. That shift siphons fiscal space. Meanwhile, a policy rate near 4 to 4.25 makes bills attractive versus bullion for some flows. But if growth cools and the policy path leans easier, real yields soften. That's when gold tends to reassert trend. Two levers. One seesaw. Players and positions. The Federal Reserve set the tone on September 17th. The US Treasury sets the calendar with quarterly refunding. The European Central Bank watches a currency that doesn't want a strong dollar impulse. The People's Bank of China manages capital preferences while local growth data chop. Sovereign wealth funds rebalance across quarters, often selling what worked to buy what lagged. Each institution reads the same math and reaches for different tools. That's why price action can look contradictory, hour to hour. Here's the contradiction most miss. On October 21st, gold made a record with the dollar firm, not weak. That implies the move wasn't currency debasement theatre, it was a confidence hedge. 24 hours later, the quick drop happened while the policy backdrop didn't change. That points to balance sheets, not belief. When books need cash, even favourite trades shrink for a day. Let's decode the plumbing. Futures positioning had become one-sided into the high. Momentum skew, plain English. Too many on the same side of the boat. Dealer's hedge, stops cluster, and a small shove becomes a visible slide. That slide says more about leverage than about long-term faith. Micro cracked. Macro decides. Calendar countdown time. 3 forward beats to watch. First, the quarterly refunding announcement in early November. The mix between bills and coupons will telegraph supply pressure. Second, the next CPI print in mid-November. A cooler core would ease real yield pressure. Third, the late November policy minutes. The language around balance of risks will outline tolerance for easier settings. Countdown set. We'll restate it twice before we close because the calendar decides the tape. One more echo of the motif. Record, then recoil, then reveal. The reveal usually shows up where liquidity lives. Auction bid to cover, dealer balance sheets and cross-currency basis. If those stay orderly, then the drip looks like positioning cleanup. If those wobble, then the drip was a first knock on the door. What about central bank buying? The multi-year trend still points to steady accumulation by reserve managers in emerging markets. They diversify away from single issuer risk and toward a neutral asset. That doesn't mean they chase every tick. Strategic buyers often step back when speculative froth appears and reload when froth washes out. Follow the money, not the tweet storm. The fiscal side can't be ignored. On October 16th, fiscal year totals put interest costs into the political mainstream. When interest becomes a top 3 line item, policy space narrows. Markets price that with term premium rather than with speeches. If issuance tilts toward longer maturities in November's refunding, that's a quiet admission of constraint. If it tilts short, that's a bet on future cuts. Either way, the choice bleeds into gold's relative appeal through real yield channels. Now, a brief translator tag for term premium and real yield together. Real yield is what a bond pays after subtracting inflation. Term premium is the bonus for locking up money longer. Gold competes with those. When both compress, gold breathes easier. When both expand, gold faces a headwind. Simple, not mystical. Mid-script cliffhanger. If the early November refunding skews heavy to coupons and the next CPI runs hotter, the snap you saw won't be the last. If instead the mix stays bill heavy and core cools, the late October drip will look like a reset on the way to a new range. Let's add 2 historical rhymes beyond 1971 and 2008. In August 2011, a US credit rating downgrade collided with European stress. Gold surged, then retraced, then marched again as real yields dived. In October 22, global real yields spiked, crushing duration trades. Gold sagged until policy hints of easing emerged months later. The common thread isn't mystique. It's the cost of safe money versus the confidence in issued money. Who benefits from the current setup? Balance sheet lenders when collateral is pristine. Short bill buyers when policy is tight? Who faces constraints? Deficit funders when auctions tail. FX managers when dollar carry tightens. Metal sits in the middle, reacting not to headlines but to where the next marginal dollar finds the least resistance. That's why a record can coexist with a quick drip. Flows first, stories later. Back to the 3 tells promised up top, but first, One more countdown reminder. Early November refunding, mid-November CPI, late November policy minutes. Those three beats will confirm whether October's message was balance sheet noise or policy credibility signal. Scorecard before the close. Auctions, firm or soft. Real yields, rising or falling. Central bank flows, adding or pausing. That's the dashboard institutions watch, not 1,000 hot takes. Now the payoff, clean and quick. The three tells that decide flight to safety versus policy credibility shock. Real yields below recent ranges on a cooler mid-November CPI, while auctions are firm. That favours a renewed gold advance on easing pressure. Auction tails widen in early November with a coupon-heavy mix, and real yields hold high. That favours more chop or downside pressure as carry-out competes metal. Language in late November minutes shifts toward growth fears and balance sheet tools. That shifts term premium down and resupports gold even without dramatic rate moves. The motif closes where it began, record, then recoil, then reveal. Gold didn't just drip, it delivered a message. The market's reading it right now.